Luke Hanson McDonald here. Welcome back to Beyond the Family Business. So I spend a lot of time on this channel talking about family dynamics, stories of other business families.
So our family crossed the Indian Ocean and went to Kenya.
Talking about the pros and cons of family business and things along those lines. But I don't spend much time talking about investment strategy. And that is a huge part of what my day-to-day is spent focusing on. I work for my single family office, and we invest in everything from public equities to private equity, real estate to fixed income, as well as other alternative strategies. And I've been very fortunate to learn from some of the brightest minds in investment here in Canada. I try to read as much as possible. I listen to a lot of different podcasts on different asset classes. And I thought it would be interesting to share some of what I've learned from the perspective of a family office member. Of course, these are my opinions, and as always, they're prone to changing over time. I'm still very much so learning and on my own journey. I wanted to share what I've learned so far and some of the mistakes we've made along the way, hopefully so you don't have to. All right, let's jump into it. All right, so in this episode, I'm going to be touching on the two broad categories that we bucket all of our investments into: directly managed investments and indirectly managed investments. All right, so now I'm going to define each of these terms. I forgot to do this, which is why I'm wearing different clothing. It's a different day. But so directly managed investments are investments that our team manages ourselves. They're much more hands-on. They take a lot more time and effort and money in order to manage them. So for example, this could be real estate, where we buy a property ourselves. We are the property manager. We have to find the tenant. We deal with maintenance, etc. Or it could be private equity. This has really been the cornerstone of what we do, is directly manage private equity. You know, we create our own deal flow where we source the deals ourselves. We actually buy the business, we structure it. We form the leadership team. We set the budget and strategy with that leadership team, and we hold them accountable. So there's a lot of time and effort that goes into that. We've also done direct investment in things like venture capital or in private debt. All right, and the second term, indirectly managed investments. These are, in a nutshell, advisor-led investments. So we are making the investment with an advisor who is a specialist in a certain area, and they are doing the bulk of the work. As a result, it's much less hands-on. So for example, it could be, public equities, where we have a stockbroker or wealth manager advising on which ones to invest in, or fixed income is done very similarly. It could be real estate funds or private equity funds or hedge funds. There's a wide variety of different types of advisor-led investments. The important thing to understand is the advisor is doing the bulk of the work. They deal with, a lot of the structuring, they deal with fundraising, they deal with reporting, they deal with the management. So it's very, very different from directly managed investments in that regard. All right, now let's jump into the pros and cons of each. So let's start off with directly managed investments. This is a big part of our portfolio. We really believe in it. Some of the strengths include, first of all, you build in-house competency. So, if you are directly managing something, whether it's private equity, so you own a business, or it's real estate or something else, over time you will start to build your own understanding how to manage that thing well. And, this is really important if you want to have a scalable benefit, in the market, where you have a core competency, you have people on your team that really understand a certain asset class. It's really important to build that in-house knowledge, and direct management affords you that ability. So the next thing is, with directly managed, is it gives you much more control and transparency. You can decide what to do with that asset. If it's a property, you can decide if you want to rent it out, you can decide if you want to sell it. And from a transparency point of view, you know what's going on with who the tenants are, with what's going on with the financials, if there's any disputes, if there's any other issues. And so that is a big part of the peace of mind you get from directly managed, is you're rolling up your sleeves and dealing it with yourself, and you know that you have that control to change course if you want to. The last thing about directly managed is it's much more tangible to the ownership. While that doesn't sound like it may really matter, I can certainly tell you that as being part of a family business, the businesses we own directly, the real estate we own directly has much more meaning to us. And, you think about it from the point of view of if you own a business, you know the people who work for you there, you know your customers, you know the impact it has on your community. So there's a much more tangible connection, which does psychologically influence you. And there's been many people that say, family businesses really stick together better when they do have direct managed investments, because it's a source of pride and something tangible to hold on to. So that's definitely a benefit. So now moving to the downsides of directly managed assets. Generally speaking, they are less liquid. Of course, that's not always the case. You could own gold bars or something like that you can go and sell pretty quickly for cash. But certainly if you're doing private equity or you're directly owning real estate, those are both assets that it takes a long time to convert them back into cash versus, again, indirectly managed things, like public equities may actually give you a much faster path to getting back to liquidity. So that's always something you got to keep in mind is what is your liquidity needs. And now directly owning assets can throw off cash, but actually converting them completely back into cash can certainly take a lot of time. The next downside of directly managed assets is they are often less diversified. So if I own a business or I own property, it's a single asset, and so that property is exposed to that local economy, it's exposed to the currency, it's exposed to the vacancy in that area. And if I own a business, yes, that business could touch multiple geographies or multiple currencies, but it's still a single business, so there's a lot of concentration risk with it. And so that is definitely one of the major risks with directly owned assets, is they are generally less diversified when you compare them with indirectly managed assets. All right, so the last risk I wanted to bring up for directly managed investments is the time and effort and cost of managing things directly. If you own real estate directly, you're going to have to buy and sell that property yourself. You're going to have to manage the property, the maintenance, tenant disputes, all those different things. And you can outsource components of that, but you're still managing all those pieces together, which does take a lot of time and effort to do well. And, it's the same thing for private equity. It takes us a lot of time and effort and money in order to manage our private equity investments properly. And that's taken years to build that competency. We have some very skilled people that work with us that make that possible, but it's certainly not for the faint of heart. And, indirect investments as a comparison take way less time and effort to manage, which I'm going to get into next. All right, so now on to indirectly managed assets. So the first benefit is more liquidity. This is not always true. There are examples of closed-end funds, as an example, where your money may be tied up for a decade, but there are generally more paths to liquidity in our experience with indirect investments. So, it could be fixed income, it could be public equities, it could also be different types of open-ended funds where there is a way for you to pull your money back out. Now, they do have the ability to gate those funds, which means they basically lock down any disbursements from those funds. But generally speaking, we've found there is much more liquidity when it comes to indirect investment than direct investment. And then similarly, we find it's easier to get access to diversification through indirectly managed assets than it is through directly managed. So, if I invest in a real estate fund versus buying real estate directly. That real estate fund will have properties in different cities, in different currencies of different types even. It could be some multi-res, it could be some industrial. Generally speaking, we find indirect investment gives you a better diversification of a wide variety of variables. So that's one of the big benefits. So the third benefit of indirectly managed assets is you get access to specialized, hopefully very competent advisors who have taken many years of their life to really learn a specific niche, and it's very low effort on your end. As I said, with direct investments, it's very difficult to be good at everything. You can spread yourself too thin, and so we find when it comes to really specialty investment classes that we don't have any background in, it's much safer and easier and cheaper to work with an advisor who specializes in that particular area and brings decades of knowledge and a team that understands that particular asset class, and it takes so much less time, and that is incredibly valuable to us. So now let's move on to the risks when it comes to indirect investment. Generally speaking, you have less transparency and less control with indirectly managed assets. So, if I'm investing in a fund, you get reporting each quarter. You may get to talk to the advisors directly every once in a while, but you really are trusting them, to follow regulation and do things properly. And we have had a number of frauds with very well endorsed investments where things were going on that were not what they said was going on, and behind closed doors they were exposed to things that they weren't supposed to be, etc. They were using money in ways they shouldn't have, and that is always a risk of indirectly managed assets, is that you don't have that direct control. You don't have that peace of mind that you really know what's going on with the investment on the ground, and the team members on the ground. So that is definitely a big risk, and it's something you have to be comfortable with. Again, there's lots of really good regulation in place, but it's that extra peace of mind that, as an investor, that's why many people like directly owned assets, is they like to have that control and that transparency. All right, and the next one is hidden fees and expenses. This is something that, you got to really read the fine print, and you got to really stay on top of, because you don't have that transparency to the day-to-day of the management of these investments. They're indirect. So, you're losing that transparency, and with that, there's a lot of room for management to have unnecessarily high expenses that erode your upside. I may do a video on this at some point, that there's a lot of proof that owning an index ETF is a much better option than having an actively managed portfolio of public equities. And a lot of it comes down to that management fee. There's a real cost to that, and that erodes your upside. So it's something you really have to watch out for. All right, last but certainly not least is the inverse to what I said on directly managed assets, around tangibility. Indirectly managed investments are much less tangible, and with that, they have much less meaning and purpose. This can be good because it will make you make very objective decisions, and it, for some people, or certainly for some portion of everybody's investment portfolio, that makes a lot of sense. But I can certainly speak from personal experience that my family has always loved and had a passion for working with our team members in our directly managed investments. And I've learned so much from working with those team members. Most of my mentors have been in our directly held investments, and I would not have been afforded that same opportunity had we been completely in indirect investments. As you can tell, I'm passionate about this point, so I don't want to oversell it, but it is a real downside of indirect investment is you lose that human connection with your capital and with what you're invested in. All right, so now the conclusion. The most important thing to take away from this is that there are strengths and weaknesses of both directly managed and indirectly managed investments. What matters most is you understand your own needs, and then that will determine what is the right mix of these two categories. What I've often seen is that directly managed investments are where people start off. You're an entrepreneur, you've started a business, or you get into real estate or whatever it may be. And so as a result, the indirectly managed investments, they're the counterweight to balance out that asset allocation. So, if you don't have a lot of liquidity or diversification in your directly managed investments, well, then you can easily find that in your indirectly managed investments. And this has really been the process we've gone through, going from a few concentrated, directly held investments in the private equity world to now having a much more broad asset allocation that gives us that flexibility that fits our needs as a family and as a business. All right. Thanks for your time. Please like and subscribe. Take care.